Hey everybody, welcome to the channel. In light of some of the recent headlines, you might think that we're going to talk about tariffs today, but I can't do it. Tariff fatigue is real, and I'm kind of tired of talking about it, so we might talk about it later in the week or next week, but today I actually want to take a break from all the trade talk and talk about stagflation. In the world of macroeconomics, almost nothing generates more concern than hearing the word stagflation. This is because stagflation challenges conventional economics. When growth slows but inflation accelerates, traditional tools and models often struggle to keep up. Wages stagnate even as prices rise, unemployment increases while everyday costs climb. For many, it can feel like progress has stalled out even as life gets more expensive. Today, with global inflation still elevated and growth projections softening in various regions of the world, discussions of stagflation are resurfacing much like they did in the 1970s. Central banks are facing difficult trade-offs, and for households worldwide, the cost of living often seems to be outpacing earnings. Stagflation does present a challenge, but it's not a dead end. It complicates the use of traditional economic tools, but also invites innovation and adaptability in policymaking. So today, let's try to understand why stagflation is such a complex issue. But before we get into it, if you find this video helpful or insightful at all, please like and subscribe. It helps us out more than you know. So in standard macroeconomic models, inflation and unemployment tend to move in opposite directions. Strong growth usually means lower unemployment and gradually rising prices. In contrast, slower growth typically brings higher unemployment and easing inflation. This inverse relationship, represented by the Phillips curve, has guided economic policy for decades. But stagflation challenges this curve. It describes a situation where inflation and unemployment rise together, an outcome that was once thought to be highly improbable in economics. Evidence supporting the reality of stagflation became evident during the 1970s, when both inflation and unemployment rose in tandem, revealing limitations in existing models and highlighting the need for a more flexible understanding of economic dynamics. Today, stagflation is not seen as a predictable part of the economic cycle, but it is a known and pretty complex phenomenon that can emerge under certain structural conditions. Now, the actual term stagflation gained traction in the 1970s, although the economic pressures began building way earlier than that. Between 1973 and 1982, the US experienced a period of low growth, high inflation, and rising unemployment. Inflation peaked around 13.5% in 1980, unemployment reached 10.8% by 1982, and the economy was slowing, and in some of those years, GDP was even contracting. The event that's thought to be the key driver of this was the 1973 oil embargo, which caused energy prices to quadruple and affected nearly every sector in the economy. These supply shocks created what economists call cost-push inflation, where constrained supply drives prices upward despite the weakened demand. This inflation was persistent. As workers demanded higher wages to match rising prices, businesses passed on those costs to consumers, triggering a wage-price cycle. Delayed monetary responses also played a role in this. However, this event was not just isolated to the US. No, other nations experienced similar conditions, but navigated this period a little differently. Germany and Japan, for instance, they also faced inflationary pressures, but they responded with a mix of industrial policy and monetary adjustments tailored to their unique situations and avoided much of the impact. In typical inflationary periods, central banks raise interest rates to cool demand, and in recessions, they cut rates to stimulate growth. But in stagflation, these levers interact in a more complicated way. Raising rates to curb inflation may deepen the slowdown, while lowering them to support growth may worsen inflation. These trade-offs require nuanced, context-specific responses. So what do? Well, monetary policy alone may be insufficient. During stagflation, consumers are likely to cut back spending due to declining real wages, while businesses face high input costs and reduced investment confidence. So fiscal responses like targeted subsidies or public investment can offer relief, but they also risk fueling further inflation if not carefully calibrated. Developing economies in particular face additional hurdles. Limited policy tools, external debt pressures, and greater exposure to commodity price volatility can constrain their options and exacerbate the problem. But this is the big question on everybody's mind. Are we seeing stagflation today? Well, right now, economic signals are pretty mixed on this issue. Inflation has leveled out a bit from its peak during the pandemic, but it remains pretty stubborn in key areas like housing, energy, and services. The US Bureau of Labor Statistics core inflation was above 3.5% in February of this year, which exceeds the Fed's 2% target. Unemployment rose slightly to 4.2%, and wage growth has cooled off a bit as well. In Europe, economic activity is also pretty quiet. Germany experienced a technical recession in late 2024, while the UK and Italy report near zero growth. Energy price instability, influenced by geopolitical tensions and climate disruptions, continue to pressure both households and businesses. Emerging markets are also navigating stagflationary risks. In countries like Argentina, Nigeria, and Pakistan, high inflation is coinciding with currency depreciation, fiscal stress, and employment challenges, each shaped by local structural and institutional factors. So while this isn't stagflation in the textbook sense, the warning signs of persistent inflation combined with slowing growth, they're definitely present in a lot of regions across the world. But unlike in the 1970s, today's risks are more structural and global. For demographics, you have aging populations in advanced economies, which is limiting labor force expansion and productivity. Also, I know I said I wasn't going to bring it up, but tariffs are playing a role in this too. Supply chains are being reshaped by the resulting geopolitical shifts, trade fragmentation, and national security concerns. And finally, high public debt levels limit fiscal flexibility, especially where inflation is already a concern. All of the issues that are raising the alarm about stagflation vary by country, but all of them contribute to the broader environment of inflation-prone, low-growth challenges. All that to say, the 1970s absolutely offer some important lessons, but today's global economy is simply different. In many countries, labor markets are a lot more flexible than they were back then. Central banks are more independent and transparent. Inflation expectations, while elevated, remain more stable than in past decades. For example, the University of Michigan's survey shows that long-run US inflation expectations are still only around 3%. Meanwhile, other countries like Indonesia or South Korea have shown that proactive central banking, diversified energy sourcing, and digital infrastructure investments can mitigate a lot of these inflationary and growth risks. Stagflation is not inevitable here, but it does require careful country-specific responses that balance short-term support with long-term resilience. So in conclusion, stagflation isn't just an anomaly in the business cycle. It reveals the tensions within economic systems under stress. When supply and demand both falter, the traditional tools we're accustomed to have to evolve to fix the problem. If you found this video helpful, please like and subscribe below. And until next time, have a good one.